Welcome back to EDS, and in this video we are going to take a look at how you can write your own options contracts, collect a premium upfront and generate a consistent return year on year. We're also going to take a look at a live portfolio and see what we can do to manage those positions, and give you some insight on that side of things as well. So the first thing we want to do is pull up your brokerage platform, and then get up a watch list, so you can take a look at some securities basically. Um, Once we've done that, this is just a basic standard watch list. You can have your own watch list. It doesn't really matter. What you want to do is see where you are in the expiration cycle. So everything denoted by the orange W's is a weekly expiration. That's a quarterly expiration, and then everything that's just normal, like the September 20th with nothing on there, that's your monthly expirations. We like to stick with the monthly expirations. So the first monthly expiration that's available is September 20th, which is 17 days away. We're not going to go with September 20th. It's a bit too close for our liking. So we're going to go a bit further out to the October 18th, which is 45 days out in time, which is actually perfect for us. So now that we have that information, 45 days out in time, we can go back to our watch list and we can filter out everything that has earnings within the next 45 days. So now we are left with a list of securities that do not have earnings over the next 45-day period. Now what you want to do is you want to order the list from highest implied volatility rank to lowest implied volatility rank. So as you can see here at the top, we've got an IV rank of 69, and at the bottom we've got an IV rank of 6.3. Okay, so now it's a case of simply going through the watch list one by one and trying to find opportunities, trying to put some positions on. So anything above 50 is considered high, anything below is considered low. However, you do need to be in tune with current market dynamics, I guess, because anything over 30 right now is kind of high, it's okay, but anything above 50 really is genuinely high. So the first thing on the list here is BA, which is Boeing. We're just going to take a look. As we can see here, it does have earnings. Its next earnings date is October 23rd, sorry, which is 5 days after the expiration of our October 18th contract. So let's just take a look at the October 18th strike. And what we want to do is we want to have a look at the spread first of all. Okay, so we want to have a look. What is the spread? The spread is the difference between the bid and ask. Okay, so for example, if we look at the 165 strike, we have a bid of 6.5 and an ask of 6.65. That's obviously 15 cents wide up here. And we've got a bid of 8.95 and 9.1, 7.5, 7.65. So as you can see, everything is between 10 and 20 cents wide, which isn't bad. It's not the best. If you compare that to the SPY, for example, and we go to the October 18th, and we look at the spread here, 11.99, 12.02, they're pennies wide. But SPY is obviously far more liquid. That's the reason why. So we want to check the spread first of all. So BA, I guess it's okay. It's not the best, but it's okay. It's not bad. So now what we want to do is we want to look at the deltas. So we want to be anywhere between 16 and 20 deltas, right? So as we can see here on the call side, we've got a 15 delta and a 20 delta. So spoiled for choice here. Let's just go with the 15 delta. Why not? And we've got a 15 delta on the put side as well, which is perfect. You don't always get to have a 15 delta and a 15 delta on each side. Sometimes it can be 15 and 18. It's not too big of a deal. So we've got a position marked up here at 140 and 185. We've got a probability of profit of 75% on this trade. This orange bar here shows you the expected move of BA over the next 45 days. And this green bar here shows you basically where your break-evens are. So beyond this green bar where it turns red, that's where you start to lose money. Anything inside this green bar will be making money. As we can see, the expected move is well within the range of this green bar, which is good for us. So we would collect $328 upfront in premium when this position gets filled. It will cost us 1.6k in buying power, which isn't too bad. And what we can do is we can actually play with this position to get the desired outcome that we want for us. So, for example, let's say, you know, $328, let's just say you wanted to collect a bit more, right? And let's just say, 75% is good, but it might be a bit too high for you. You might like something close to the 60, 65, 68% mark. So what we can do is we can just move this into the 20 delta, move this in over here to 21 delta. As you can see here, our break-evens are still wider than the expected move. Our probability of profit has dropped to 68%. However, we are going to be collecting more premium upfront. So you can really manipulate and play with these positions to your liking. I wouldn't really go too much further than about a 20 delta, maybe a 25 delta if volatility was exceptionally high for any reason. However, beyond there, you probably would be best just going with a straddle. But for me, 16-20 delta is good to go. You can also uh, go long on a contract below it. So for example, this is $5 wide at 180, 185, 145 and 140. We can just buy a contract slightly further out of the money than the original short contract. And what that's going to do is that's going to massively reduce our buying power requirement. It is going to massively reduce our premium that we collect, but it's also going to massively reduce the buying power that's required. It is going to reduce our probability of profit. However, in turn, we have a much higher return on capital. We're going to be collecting $157, and it's going to cost us $344 in buying power. So our return on capital is much higher by covering our shorts, and this is called a iron condor. If you did want to go with the strangle, then I would probably stick to the 40 and 15 delta, somewhere around there. And that's basically it. This is a prime example of a position. Let's say for whatever reason you didn't actually like this position, so you decide to just keep going down the list, and you can just have a look at GLD. GLD, same story. We just literally do the exact same thing all over again. We just mock up another position, see if the numbers make sense, see if we like it, and then if we do, by all means, we could put a position on. Next up, we've got AMD. AMD seems to be down a little bit, but it's not really any cause for concern. We can see that the market price is moving towards our short spread here, but that's not a problem. Implied volatility is coming down. Hopefully, we can see a bit of a bump in the market over the next couple of days. Get this P&L green. CMG, if anybody remembers CMG, this was actually red. This was more red than what AMD is now, and currently it is green. As we can see, as the position started to move closer towards our short call, our P&L did start to go red, and now price seems to be moving back towards the middle of the range, and we are back green again. Hopefully we can see the same thing happen with AMD. GDXJ, we have still got this position on with GDXJ, as we can see. Again, similar situation, prices coming down. It would be nice to see a bit of a reversal there. We did have an iron condor on with GLD. We did close it out in profit. We managed to take 20 cents of profit, which was about 14-15% of our way to of the total amount of premium that was collected. It was a perfectly fine position. I did not want to take it off. The only reason why we took it off was because I needed to free up some buying power. This is a small account, and we are super leveraged in this account. So we are making adjustments and things like that on the fly every single day, depending on what needs to be done. So we did close GLD. That was more of a proactive adjustment to the portfolio as opposed to just following the mechanics. But GLD was a beautiful position. It still is, to be fair. We just needed to free up some buying power, and because we've already got a strangle on GDXJ, you know, if I had to pick between the two, if I had to pick between an iron condor and a strangle, I'm always going to go with the strangle. So yeah, so that's what we did with the GLD earlier on. Intel was green a little bit earlier. However, we are still green on the day. Let's have a look at Intel. We can see here price seems to be coming back into the range a little bit. UV basically at break even. mRNA, SMH, UAL, SMH has come down a little bit. Again, that's just because of the red day that we've had here. It's nothing to worry about. Hopefully we see a little reversal in the coming week or so. Just to help our P&Ls a little bit, but it's fine. We still got theta decaying in our favor. UAL, let's have a look at UAL. Nothing of concern here with UAL. The main thing to note is the GLD position that we did close out. Like I say, it was purely just because we needed to free up some buying power. We've also got, we've still got a GDXJ on anyway. So with that being said, you need to know how to size your positions correctly, how much money to allocate to certain strategies. And what we've done is we've created this position sizing template for you. Everybody can get a copy of this. The way it works is you just put in the size of your portfolio. So let's say if it's let's say your portfolio is $6,859 and the VIX was currently at 32.1. Everything below would then be automatically calculated for you. All you need to do is then just follow what's written here and use this as the backbone of your portfolio. Use it as your guidepost, and of course there is an explanation below, so you know what all the numbers mean and how everything's being calculated. Now you can get yourself a copy of this. Just drop us a message in our Discord group. This is our Discord here. EDS Premium. What is EDS Premium? So you get a full course that teaches you everything from novice to expert. You get access to all of our portfolios, small and large portfolios. So it doesn't matter which size portfolio you have, you can see our positions and copy us if you choose to, so you can learn and earn at the same time. Of course, it is a private community, so you can speak to myself directly as well as other members that are all on the same journey. There is a 100% money back guarantee, so if you study our full course and follow our trades for 6 months and you haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. Right now, it costs £1 a month. The price will increase for every 5 members that join. Whatever price you get in at, you are locked in at that price. So once you're in, you don't need to worry about any price increases in the future. You'll just pay whatever price you paid at the beginning. So with that being said, I'll see you guys on the inside.